Morning, everybody. This is the first of many lives that we're going to do, or that I'm going to do, not we. There's nobody else here but me, about Canadian real estate, Canadian mortgage market, just topics of the day. Every Monday to Friday, we'll be doing these lives. Again, not we. I will be doing these lives. Hope you join me. If you find these great, then that's amazing. Please subscribe and like the videos while we're streaming, so that oh, it's saying that we're live now. Well, maybe I'll just restart. How about I restart? Welcome, everybody. First live. I'm going to do Monday to Friday. We're starting on a Friday. That's weird. I don't know why, but I'm just doing it. Talking about current mortgage interest rates and just real estate news in general in Canada. I'm not going to dive too far into politics or anything else. I'm just going to stay focused on the task at hand. Wanted to talk today about why mortgage rates are dropping in Canada. I mean, we know that the Bank of Canada has dropped their overnight lending rate at their last meeting in July by 25 basis points, and we've all heard those headlines and that news. But now we're seeing fixed interest rates in Canada starting to really come down quite nicely, actually. Over the last 90 days, they've dropped about 70 basis points or so on the fixed, the 5-year fixed, and the other 3 in the 2 years will follow suit. But the key thing is why? Why is this happening? Well, this time around, it's happening this week in particular because of the U.S. Treasury numbers. The U.S. 10-year Treasury is dropping as well. And also Powell, the Federal Reserve, the chairman of the Fed, Powell has said that his language is in such a way that they're basically saying there's going to be 2 rate cuts this year south of the border. So those will be the first rate cuts from south of the border since the pandemic started. And this is going to help mortgage rates south of the border. But in Canada, we follow suit as well. Excuse me. So that's actually doing us a little bit of a favor. What that means is because those treasuries are coming down, our bond yields are also following suit. And what we're seeing in this market is affordability is starting to change a little bit for the consumer. So if you're a home buyer and you want to purchase a home, you need to qualify on the stress test here in Canada. The stress test is either 5.25% or 2% over your fixed rate contract rate. Well, if the fixed contract rate was 509, I'm talking about a 5-year high ratio mortgage. If it was 509, it's now 469. So that spread there is seeing about, about $14,000 on affordability increase for maximum mortgage and maximum purchase price. And also a slight decrease in the monthly payment because that rate has come down. The monthly payment for that affordability bracket is dropped about $10 a month. It's nothing groundbreaking, but it is something. So interesting to see how the fall pans out. Bank of Canada and bank analysts, let me back up. The Bank of Canada, as I posted in one of my videos last week, their messaging was clear, but not, the words weren't clear, but the message was clear that household spending is down in Canada. We're just grinding to a halt with household spending. And as all of you know, if you're buying groceries at the grocery store, if you're having to finance a new vehicle, things are crazy. Things cost so much money now that the average Canadian family is just, pulling the belt as much as they can on everything. And there was a joke there a while ago about our finance minister here in Canada saying that, gosh darn it, our family even canceled our Disney Plus subscription to save money. And she got some heat for that. But I feel like even now, further along down the road, a lot of families are doing this. A lot of families are looking at their household expenses and making cuts where they're just, it's seepage. It's what I call seepage. It's monthly seepage. There's no fixed cost going out, but it's those credit card recurring bills that people are canceling to save that money because household spending is hurting and the cash flow in the house is hurting. So this is a bit of relief. It's like widely published and broadcast that most mortgage renewals in Canada are going to be coming up in 2025 and 2026. A huge amount of those mortgages are coming up for maturity. And that's fantastic because it will be high. The rates will be higher than what you would have locked in at if you're a homeowner and you have a mortgage. But the relief here is that rates are on their way down. And as these rate cuts continue to happen, so will the rate decreases on the fixed market. So right now you're seeing fixed rates in the fours, mid to high fours